All right, so thank you to everyone for joining us today. It's very nice to have everyone here. It is my great pleasure to introduce today's guest speaker, Paul Merriman. Paul is a nationally recognized authority on mutual funds, index investing, and asset allocation. After founding the Merriman Wealth Management Group in 1983 and retiring in 2012, Paul then established the Merriman Financial Education Foundation to empower investors with valuable knowledge and tools. He is an accomplished author, a regular contributor to MarketWatch, and the host of the acclaimed Sound Investing podcast. His latest project is at Western Washington University, where Merriman Financial Literacy Program will make financial literacy a priority for all WWU students. Paul's dedication to investor education has made a significant impact, and we are honored to have him with us today. Before we get started, just a few housekeeping items. The Q&A function is available to ask questions to Paul. Now, Paul's got a jam-packed schedule for this presentation, so he will answer your questions in an upcoming podcast episode dedicated as a follow-up to this presentation. So feel free to put your questions into the Q&A and also to upvote any posted questions that particularly resonate with you. We're working on the chat function
Should be
so that
working.
you're able to converse with other attendees during the presentation. And if you would like to receive a follow-up email with a link to this recorded session and a link to Paul's follow-up podcast episode, there's going to be a form link at the top of the chat to register. We're also going to put links in the chat for anyone that would like more information on Paul's work with the Merriman Financial Education Foundation or his work at Western Washington University. And now I'm very happy to say, please join me in welcoming Paul Merriman to the group.
Kelly, thank you very much. And thanks to you and your husband, Jonathan, for putting this all together. I really do appreciate it. I love speaking to people with Choose FI. It is, well, to begin with, I think it is the premier website for the discussion about this financial independence, retire early movement that many of you were on. I hope that some of this information will serve you not just in getting there to that number, but doing the right thing after you have gotten to that early retirement. So my work is always about helping do-it-yourself investors. It's always about figuring out how can we make a better rate of return without taking any more risk. In fact, if we could take less risk, I would go for that as well. And at the end of the day, I think having peace of mind is key to being a lifetime successful investor. John Bogle talked about staying the course, that is the goal for an investor. And for some people, that could be all bonds. For other people, it could be all stocks. But to find that place where you do have a sense of peace of mind. My own history, if you will, as an investor and a teacher of investing really started 60 years ago. And for the last 30 years, or the period from 83 to 2012, as Kelly mentioned, I ran and built an investment advisory firm in 2012, started a foundation, a nonprofit devoted purely to educating from first-time investors to those who have been around a lifetime. I have been very active at Western Washington University for the last decade plus in building a program there that has culminated in a new program that actually will bring financial literacy to every student. One of the keys to being a successful investor, I think, is not about understanding mutual funds or understanding Roth IRAs and all of the bits and pieces that have to do with investing. I think it should all start with the concept of follow the math. And what is that math about? Well, let me just show you, if I might here quickly, a couple of scenarios. And the scenarios represent two people who would be putting money away each year, exactly the same amount, $6,000. They would each do that for 40 years. They would then retire, And after they retire, they would start taking out a regular income of 4% a year. And they would do that until they're 95. And at that point, that would be the end of their life. And whatever they have left over, that goes to the heirs or to charities. Now, here is the math we need to understand. If one person makes 8% a year, another person makes 8.5% during the accumulation, and then the first person makes 6% a year during the accumulation, and during the distribution period, the second person makes 6.5%. What you have done, however you did it, was you made an extra 0.5%. And what is so important for us to understand is what is the bottom line impact over a lifetime as far if you could find an extra 0.5%. Because a lot of the work that I do is simply about looking, the search for that extra 0.5%. Well, here we see in scenario one that you had invested $240,000. At age 65, it was worth almost $1.7 million. At age 95, after taking out $2.6 million over that 30-year retirement, you left $2.8 million to your heirs. That is at the 8 and the 6%. On the other hand, if instead of the 8, you got 8.5 instead of 8, you would have 1.9 million at age 65. You would have distributions of 3.2 million over the 30 years of retirement, and you would leave 3.7 million to your heirs. The difference between those two, the income that you took and what you left, which is really the return on your investment. With the first scenario, you had 5.5 million over a lifetime. And in the second, with that extra 0.5%, almost $7 million. So my point is simply this. I don't care whether you're 20 or 40 or you're 60. That extra 0.5%, and you'll see this later for people who are planning towards retirement, what that extra 0.5% would be. So I certainly am interested in helping you find that extra $1.5 million or more. But what if instead of 0.5%, it was 1%, so that it was 9% instead of 8.5%, and it was 7% instead of 6.5%? The bottom line impact of that is that instead of having $1.5 million difference, it would be $3.5 million. And you might have thought, well, if I got an extra 0.5% and the 0.5%, the first 0.5% got me 1.5 million, then I would double that. But no, as you know from the impact of compounding, you are making money on the extra money, and over that lifetime, you made an extra $500,000 over a simple double of that first 0.5%. So you have gone from having 5.5 million in scenario one here to having 8.9 million in scenario three. So now it makes me believe if I could help you find 1% instead of 0.5%, it could be a life changer. Maybe not such a life changer for you, but maybe for your heirs. And then we look at another set of situations. Instead of it all being dependent upon the market, what if it turns out that you could make the difference? You could make the difference by not only just investing $6,000 in scenario three, but instead in scenario four, put an extra 3% a year in. So instead of investing $240,000, you invest $452,000. Now that's a lot of extra money. It's over $200,000 more. But look what it is worth in extra return based on the 7 and the 9. Now you are up to $12 million instead of $8.9 million. That extra $200,000 led to almost $3.5 million more. And so that tells me that you have a big part of that long-term success that you're going to get. And just one more table about the math. The math between starting 5 years earlier, waiting 5 years, that is a common study that people do to show the impact of that. Well, let me show you the impact as I see it. Because if we go through this 40-year period, and one person, let's say, starts at age 25 and they go to 65, the other one starts at age 30 and goes to 65. So they have 5 fewer years to have that money compounding. But the part that is so wonderful is that first 5 years of investing, that 30,000 plus the 3% increases that we made each year, that would take that portfolio from about $7.8 million here, starting at age 30, up to $12.4 million. So putting it all together, starting earlier, putting away more, making more, these are not small differences. And so as I move forward and make the presentation today, I am going to be looking everywhere that I know where I think you would do better. Sometimes that's by you doing the right thing. It may be just staying the course. That may be the one thing that you are challenged with. You can do everything else, but you somehow have a hard time staying the course in really bad bear markets. We need to look at all those little nooks and crannies and ask, how could we be better? And if you don't like numbers, our website may not be a lot of fun for you. We have over 200 tables of numbers. I will share a few of them with you this morning. But before we dig into the numbers, let me focus on a belief, a philosophy, an approach to investing that I think may be the key. If there is a secret to long-term successful investing, and obviously when you learn this, the answer to the question, what is the secret? Well, it isn't very secret, as you'll find out, but I think it is really important. And that is to focus on defense. Defense. Most people think of investing from the offensive position. I really believe successful investors, if you look at the decisions that they make, in almost every case, the decision that is made is defensive, not offensive. So there is one offensive, really aggressive thing I want you to do. And that is, I want you to invest in stocks. I want you to put money in the part of the market where people are expected over a long term to make a better rate of return than if they put their money someplace safe, because investing in stocks is not safe. Over half of the public companies since 1926 have gone out of business. And as a matter of fact, it is a very small number of stocks that have driven most of the great return we all think about when we think about the stock market. So once you have made the decision to make stock the place to put your money for the long term, then you come to a fork in the road. Put all your money in one or many. Well, obviously, many stocks is defensive. Are you expected to make more by owning more stocks? Because wouldn't that be nice? You take a defensive strategy, you do something to protect yourself and expect to make a better rate of return. And that is, in fact, what the academics tell us. The more diversification you have, the greater the likely return over the long term. And many of you think you've solved that problem by putting your money in the total market index. In fact, one of the questions that was asked on that list of 21 that many of you responded to was whether or not you could just invest in the total market index. You get lots of stocks. You get 3,500 stocks, or the S&P 500. You get 500 stocks. Well, you will see that beyond that, there's another level of diversification of many that actually has a bigger impact on you. The third is whether you make the selection of those stocks or you hire professionals. And if you got a lot of money, well, in a way, you don't have to have a lot of money to have professionals manage it. You could put it into a target date fund. You could put it into a robo-advised. They're both the same thing. A target date fund is a robo-advised fund. And you would, in fact, have professional management. But everything that I know, comparing what you do as a group and what professional managers do, the advantage is huge. And I'll share that with you in a few minutes. But to the extent that you're going to get professional management, you could hire somebody to do it for you individually, for you alone. But it normally takes a lot of money to do it for you alone, or you can go into mutual funds. And mutual funds are a great way to diversify, in a way, amongst many professionals. As a matter of fact, you could have a mutual fund. I'll introduce you to a portfolio of 10 mutual funds where you would have exposure to equities all over the world, big, small, value growth, U.S. international, emerging markets, REITs. You would have all the major sectors covered. And you would do it through a handful of mutual funds. And you'd have to have a lot of money to go hire somebody privately to do that for you. Load versus no load. Aha. Here's 0.5% right here, 0.5%. If you buy an equity fund and you pay somebody 5 or 5.75% in a commission, that means instead of having $10,000 going to work, you're going to have $9,500 or $9,425, something like that. But what that really means, if you follow it over a lifetime, is your return on equities is going to be about 10% less, 0.5% less than the return of the market. That's the real cost of paying that load. A loss of 0.5% for the rest of your life. Now, another decision that you're going to make is whether you're going to these days to be in a regular old-fashioned open-end mutual fund or an exchange-traded fund. And guess what? It turns out the exchange-traded funds defend you against taxes. And that is an important place where you are maybe going to be able to pick up another 0.5%. We'll talk about that a little more as we move along here. You can be in mutual funds that you can literally, you can buy mutual funds with no fund expense. You can go to Fidelity. They have their 0 funds where you can buy the S&P 500 or the equivalent of the total market index without an expense ratio. And yet, what do they typically get out there for a total market kind of a fund that is actively managed? That's important. Typically, it's about 0.8. Or in an index fund, you can get that for 0.1% or 1/20th of 1%, which means there's another level of choice, active management versus passive. So you put together the negatives of active management: higher taxes, less diversification, higher fund expenses. You look at all of those things that active management do to take money away from you to reduce your return, and you could pick up literally 2% a year, 2% a year. And when, by the way, you decide to be in an index fund, that means, according to the studies that are done every 6 months by the Standard & Poor's people, they look at all of the actively managed funds. They look at the benchmark, the return of the index, if you will. And if we go out for 20 years, about 1 out of 10 to 1 out of 20, depending on the equity asset class, will be able to outperform the index, which means We can choose not to be in the bottom 90% by using index funds. And the huge catastrophic event is you pay a load to get into a fund that is actively managed, that has a high expense ratio, that ends up costing you more in taxes, and then their performance underperforms the market. Just the raw performance without all those other things in consideration are taking 2 or 3% a year away from you. Just the performance. You don't have to do that. You also have the choice whether you hold some stocks or all stocks. Now, owning all stocks is not very defensive. Normally, you add bonds to try to reduce that volatility. But the beauty is, and I'll show you a few numbers today, what would likely happen to you over a lifetime if you had all stocks. But let's compare that to other combinations like 60-40 or 50-50 or 70-30. I think you'll find it interesting. Some have high turnover mutual funds. Some have low turnover. That typically leads to the high turnover to more taxes, but also there is a cost of the turnover. And at the end of the day, we have pretty good control as to how much taxes we're willing to pay. Now, I know there's a big question about, do I put my money in a Roth 401k or a Roth IRA? And they'll tell you, well, it depends on what your tax bracket's going to be after you retire. I would say it goes beyond that, because what we will probably use as our tax bracket is something we know from recency bias, something that we've learned happened to us during our life. Well, I can tell you during my life, when I came into this industry in the mid-60s, before I was a professional, but I was still investing, the marginal tax rate for the highest dollars that you made, which was anything over, I think, $100,000, was 90%. The next year it went down to 70%. The fact is, we have no idea what tax rates are going to be in the future. And I have to add that the market did okay when taxes were high. There were some bad times too, but there were bad times during periods when taxes were low. So that in and of itself does not seem to be this big a driver to the market as one might think. It will be a driver to your bottom line income if you're taking a lot of money out of an IRA and having to pay a very high tax bracket because they changed the taxes on you. If you are in Roths, you protect yourself. It's a defensive strategy or step. This is a huge one. Retire with enough or retire with more than enough. When you retire with more than enough, you defend yourself against the impact of a bad start, of a market that goes down in the early years rather than going up. I think that's a huge piece of defense. Now, you can defend against that by how much you take out. I'll talk about that in just a minute. But I will show you today the difference between retiring with enough or more than enough is not only a huge defensive step, but it will give you a luxury of flexibility that you don't have when you retire with enough. Have all your money in stocks or add some bonds. Those bonds, in many cases, actually end up helping you have more income in retirement rather than less. I will show you that today. Fixed distributions versus flexible distributions. Again, the flexible is a strategy that is totally defensive. It helps you take less when the market goes down. It helps you take more when the market goes up. The beauty is it protects you in large part from the catastrophic. I think you'll enjoy that part of the presentation. I mentioned you can take out 3, 4, 5, or 6% in distributions. If you take out 3, that's really defensive. If you take out 6, that's really aggressive, and you put yourself at high risk. Hire an advisor or do it yourself. I will tell you what is defensive about doing it yourself. And it's the biggest line item of all to most people. And that is that 1%, let's say, that you would pay for professional investment advice. Remember what 1% costs over a lifetime. If you remember with the $6,000 a year, that 1% difference, and that could be the percentage that people will pay to get professional management, they would have left about $3.5 million on the table. Now that's the bad news. The good news is when you have an advisor, you might actually do what you're supposed to do. And I think, again, when you see some results of a study that Wharton did on comparing people who try to do it themselves compared to people who have professionals, it's a huge advantage to the professionally managed account, unless you do it just like the professional would do it, which is what I am trying to help people do. And at the end of the day, education, that's the biggest defense of all. These are all simple steps. But remember, there's an industry that wants to argue at every one of those forks in the road. Load versus no load? No, because if you pay a load, that's a better way to do it, because you pay me a commission, I'll help you buy better mutual funds. Yes, they will have higher expenses, and yes, you'll pay higher taxes, but I know how to find the ones that, even after the higher expenses and higher taxes and the adjustment for the risk for not having as much diversification, I will help you find the better mutual funds. I don't believe it, by the way, because I don't know how they can know the unknowable. But the fact is that the industry, Wall Street, will have in every fork in the road that I just talked about, will make a case for taking the other fork. And I, of course, am dedicated to making sure that you stay on the right course so that you hopefully stay the course. Now, today you're going to get a little taste of 9 different areas regarding investing. For those of you who want to dig deeper, you can go to each one of these links and you'll go to a page where I dig into every one of these topics for about an hour each. You'll see a video, you'll read an article, you'll listen to a podcast, you'll see dozens, in some cases, dozens of tables to make you think about of the impact of the decision that you're about to make. So I hope some of you will decide to go to the boot camp. It's free. And I know a lot of numbers, but these numbers are much easier to deal with than you think. I'm going to show you some right now. I want to come to the biggest fork in the road first, because if you doze off here and miss the rest of the presentation, I want to help you pick up an extra $10 million. And that fork in the road is the simple decision to be in the equity market or in the bond market. Now let's look at the bonds since 1928. Short-term bonds, government T-bills, 30-day government T-bills, compound rate of return, 3.3. $100 grows to over $2,000 over the last 96 years. Now, here's how investing works. This is important. When we take more risk historically, and I'm not talking about one day at a time. As a matter of fact, if we talked about 1 year at a time, notice the short-term government bond had 1 year, it was up 14.7, but it had a year that it basically broke even or lost. 0.02%. But if you were willing to take more risk, if you were willing to be in a bond, a government bond that had a worst year of 9.4, had a better year on the upside, 29.1, your $100 would have grown to $9,541. But you got that return, extra return, because you took more risk, because you had more volatility. You can see it in the standard deviation, 5.0 versus 3.1. Higher numbers imply more volatility. But you can go further. You could go into long-term U.S. government bonds. And that $100 grows to $12,477. It's a meaningful difference, but you had to be willing to suffer through a one-year loss of 26.1%. This is the way investing generally works, not one day at a time. The lower the volatility, the lower the risk, the lower the return. And that's what you got right here. But notice, the best return was $100 growing over 96 years to 12,000. If you were in the stock market over that same period of time, if you were in index investments that have been created by the academics going back and looking at all the large companies, the S&P 500 kind of companies, looking at all the large cap value, the companies that are out of favor. Now, the S&P 500 includes some growth and some value, but you could also break out just the value. You could also break out just the small companies that are a combination of growth and value, or you could look at just the small companies that are all out of favor, the value companies. And guess what's happening to risk? Large cap value, more risky than the S&P 500. Small cap blend, more risky than large cap value. Small cap value, more risky than small cap blend. In every case, you were taking more risk, and the return over that 96 years, 10% for the S&P, 11 for large cap value, 11.9 for small cap blend, and 13.2 for small cap value. And look what happened to the $100. It's the same lousy $100, almost a million, well, 2.3 million almost there, 4.9 million, 14.8 million. And it's that relationship between risk and return. And we show you the worst 1 year. These are calendar years. S&P 500 was down 43.3. That was the worst. 61.1 for large cap value, 48.3 for small cap blend, and 54.4 for small cap value. Now, off to the right over here, we have different ways to combine those. I'll talk more about that later. The beauty is, and this is, if you